Welcome back to my channel where we learn money habits that help you build long-term wealth. My name is Veronica. I am a licensed financial service representative. So in this video today, we're going to talk about different types of life insurance policies that are out there. When people start looking into life insurance, one of the first things they realize is that there are several different types of policies. And if no one has ever explained the differences clearly, it can feel very, very confusing. And so I wanted to make this video today to walk through 3 common types of life insurance that there is. There is a whole life, universal life, and index universal life. And I also want to explain where term life fits into this conversation. My goal here is simply to help you understand how these policies work so you can make more informed decisions when thinking about financial protection. So let's start with the whole life insurance policy. Whole life is designed or was considered a permanent life insurance, which means it's designed to provide coverage for your whole entire lifetime as long as premiums are paid. One of the defining features of whole life is its level of predictability. So premiums are typically fixed, the death benefit is guaranteed, and the policy builds cash value over time. The cash value grows based on the structure of the policy and can accumulate gradually over the life of the policy. Now, because of these guarantees, most people may opt into that. They may appreciate the stability and long-term design that the whole life offers, right? However, one thing people often notice is that the premiums for permanent life insurance are usually higher compared to other types of coverage, but it also depends on your age. Now, let's talk about universal life insurance, also called IUL. Universal life insurance was designed to introduce more flexibility into permanent life insurance. Instead of having a completely fixed structure, universal life policies may allow adjustments in areas such as premium payments or even death benefit structure, right? The policy also builds cash value, and that value typically grows based on interest credited by the insurance company. Because the structure is more flexible, these policies may require ongoing monitoring to make sure the policy continues to perform as expected over time. Another type you may have heard about is index universal life. If you go on TikTok, this is so common, right? It's also called IUL. Index universal life is a form of universal life insurance. The difference is that instead of earning interest based only on a fixed rate, the credited interest may be linked to the performance of a market index, such as the S&P 500. It's important to understand that the policy is not directly invested into the stock market. Instead, the insurance company credits interest based on index performance while applying certain policy features such as caps, participation rates, or floors. This means the credited interest can vary depending on how the index performs and how the policy is structured. So when we step back and look at these 3 policies, whole life, universal life, and index universal life, they all fall into the category of permanent life insurance. They are designed for long-term or lifetime coverage and include a cash value component. But there is another type of coverage that many families consider when their family or their primary goal is protection. That option is term life insurance. Term life works differently from permanent life insurance because it provides coverage for a specific period of time, often maybe 10 or 15, 20, or even 35 years. During that period, the policy provides a death benefit designed to help protect loved ones financially if something unexpected happens. Term life does not include a cash value component, which is one reason that premiums are often significantly lower than permanent policies. For many households, The purpose of life insurance is to help protect their family during the years when financial responsibilities are highest. For example, when there is a mortgage, when children are growing up, or when a family depends on primary income. In those situations, some people choose term life insurance because it allows them to obtain a larger amount of protection for a lower monthly cost. Every financial situation is different, and there isn't a one-size-fits-all solution, right? When it comes to life insurance, the key is to understand how each type of policy works and how it may align with your goals. If you found this explanation helpful and you would like to learn more about how life insurance can fit into a financial protection plan, I've linked a free ebook educational guide that breaks down the basics in simple terms. You can access that guide through the link on my page or in the description below. And if you ever have any questions about coverage options or want to better understand what type of protection might make sense for you or your situation, feel free to reach out to me in the description below. I am a licensed financial representative, and I would love to help you or guide you in your journey. As always, thanks for taking a few minutes to learn more about how these policies work and to watch this video to the end, and I'll continue sharing more simple financial education in future videos. Please like, share, and subscribe to this channel and help support this channel. See you in the next one.